Hey, welcome! Today, we're going to break down one of the most popular and honestly one of the most straightforward intraday trading strategies you'll find, and it comes straight out of the Indian stock market. So, if you've ever been looking for a simple signal to help you get started, this is for you. You know the feeling, right? That opening bell rings, prices are just flying all over the place. It's pure chaos. And you're sitting there thinking, how on earth is anyone supposed to make a smart move in those first few minutes? Well, what if I told you there's a simple pattern that can help you cut right through all that noise? Okay, so let's get into it. The strategy we're talking about is called the open high/low strategy. It's specifically designed to give you a hint about the market's direction for the day right from the get-go. And that's exactly why it's such a favorite for people who are just starting out in day trading. And hey, don't just take it from me. The reason it's so popular is because of its simplicity. It gives new traders a clear, rules-based way to approach the market, which is so important when you're just starting out. Now, before we jump into the how-to, it is absolutely crucial to understand why this thing even works. See, this whole strategy is about one thing: reading the market's mood, its sentiment, right at the start. That very first price of the day tells a story about who's in charge. Is it the buyers or is it the sellers? And this slide just nails the core logic. Think about it. On one hand, if a stock opens and that opening price is also its lowest price, what does that tell you? It means buyers jumped in right away and just refused to let the price drop any lower. That is a textbook sign of strength. Now flip that. If the open price is the high for the day, it means sellers took control from the very first second, pushing the price down. That's a huge signal of selling pressure. All right, so now we get the psychology behind it. Let's get practical. How do you actually use this in a real trade? We're going to walk through the entire playbook, from finding the right stocks all the way to getting out of the trade. Okay, this is the heart of it all, so let's go through this carefully. First up, step 1. At 9:15 a.m. when the market opens, you're just looking. You're not trading, you're scanning for stocks that fit our open equals low or open equals high rule. Then comes step 2, and this is maybe the most important part. You wait. You give it 15, maybe 30 minutes, let the crazies do their thing, let the dust settle, and see if that initial trend is for real. Okay, if the trend is holding, then you move to step 3. You enter the trade. You go long, meaning you buy, if the open was the low, or you go short if the open was the high. Immediately after you're in, you do step 4. You set your stop loss. This is your safety net. It's totally non-negotiable. And finally, step 5 is your exit. You get out when you hit your profit goal, if you hit your stop loss, or at the very least, before the market closes for the day. Discipline here, it is everything. Now, here's a really important thing to remember. This strategy isn't for every single stock out there. It works best where there are tons of buyers and sellers, what we call high liquidity. So you're thinking about major stocks, and especially the big indices like the Nifty and Bank Nifty. That liquidity is what lets you get in and out of your trades without a hitch. Okay, let's be real for a second. No trading strategy is a magic wand that just prints money. It's so important to have a realistic view of what you're dealing with. So let's take a look at the good and the bad of this open high/low approach. You know, what's interesting here is how clear the trade-off is. The biggest pro, it's simple. It's super easy to spot and easy to trade. But that simplicity comes at a price. The biggest con is that its accuracy can be all over the place, especially on really volatile days. It can, and it absolutely will, give you false signals sometimes. And that brings us right to the biggest risks you have to think about. A false signal is when the stock looks like it's going one way, and then bam, it completely reverses. And this is exactly why having a disciplined stop loss isn't just a good idea, it is an absolute must-have to protect your money. It also reminds us that this isn't a strategy for every single day. It has its moments to shine, and moments where it's best to just sit on your hands. So after all that, why does any of this even matter? It matters because it gives a beginner a clear set of rules in a world that can feel incredibly complex and overwhelming. It teaches you to look for a specific signal, to wait for confirmation, to manage your risk, and to follow a plan. Honestly, it's a structured exercise in discipline, and that might just be the most valuable thing any new trader can learn. And that leaves us with one final thought. Look, this strategy is a fantastic building block for learning discipline and for understanding how the market feels. But the trick is to see it as a starting point, not the finish line. So I'll just leave you with this question to chew on. Is the simplest strategy always the best place to start? Or is it just the foundation you need to build a much deeper understanding?